In this video we're going to make a start on the CFA curriculum, and to start off with we're looking at quant, specifically the first reading within quant reading number 6, which is the time value of money. And in this first video we are just going to look at something fairly basic, which is learning outcome A. But there are 6 different learning outcomes in this chapter, all looking at the time value of money. And basically, the key takeaway from this chapter, or from this reading, is that you need to be able to move an amount of money along a timeline. So you either need to be able to compound some amount of money today into a value in the future, or take some amount in the future that you may receive, such as from an investment, and discount it back into a value today. Because $100 today is not going to be worth $100 in some time in the future, let's say 10 years. It's going to be worth less. So as a result, if someone owed me, or someone said they would pay me $100 in a number of years' time, that's not going to have the same value to me as if I got $100 received today. So there is this time difference and time value of money. And you're going to get good at solving these problems later on in your learning outcomes like C and D and E, is where you're going to be solving many of those problems and learning how to do those calculations. But today we're just going to be looking at the first learning outcome number A, which is interpret interest rates as required rates of return, discount rates, or opportunity costs. So when we talk about discount rates, rates of return, even though the opportunity cost, or interest rate, we're talking about the same thing essentially. So an interest rate is probably what you're most familiar with, or the most familiar term. So the interest rate, if I put my money in the bank, if I put $100 in the bank, I might receive some interest. At the moment, this probably isn't very realistic, but let's say I received 10% interest per annum, okay, or per year. What does this mean? That means after 1 year, I would have $110 in my bank account, because I'd have the $100 that I started with plus the 10% interest, which is $10, giving me 110. And the reason why I received that interest is because I gave my money to the bank today. The bank could essentially do what it wanted with it, go and make investments or loan it out to other customers. And in exchange for me giving the bank that money to use over the course of a year, they gave me this interest payment of 10%. And that's what the bank and the customer would call interest. Similarly though, in other applications or other contexts, we use interest, or the time value of money, and it essentially is the same thing, some reward for handing over our money for a period of time. But we just call it different things. So in corporate finance, when we deal with capital budgeting and trying to find projects to invest in as a company, so for example, we might go and build a new factory or something like this, engage in some project, we use the term rate of return. So the project is going to have some required rate of return. So we're going to basically take our expected returns or expected profits that we're going to get at the end of the project period and discount them back by our required rate of return. And if there's a positive net cash flow there, that's sort of the basis of capital budgeting. So in corporate finance, that's essentially an interest rate. It's the rate that our money is increasing for being employed in some use. But just in the corporate finance context, that's called the rate of return. When we're looking at some sort of an investment, maybe a bond or something, fixed income, security, instead of rate of return or interest rate, we use the phrase discount rate. So again, it's the same thing. So we're going to have some future cash flows from a bond. So we buy a bond today and we have a negative cash flow at time 0. And then in the future, this is going on. In the future, we're going to have some positive cash flows. So what we do when we price a bond is we take the positive cash flows and we discount them back to present value by using a discount rate, which is essentially a rate of interest, but just applied to that application to get the value of those cash flows today. So essentially, the discount rate, rate of return, interest rate can all be used interchangeably, or they mean the same thing. They're referring to some sort of an interest rate that we're doing a time value of money calculation with. And then finally, I guess in economics, interest can also be referred to as an opportunity cost. So as a finance professional, we don't refer to it as much in this sort of terminology, but we can do. So what is the opportunity cost of an investment? Okay, let's say I have an investment opportunity where I can invest $1,000. So I've got some investment opportunity where I can invest $1,000 and get a return on that investment after 1 year of 20%, right? So this seems somewhat unrealistic. But what is my opportunity cost of turning down that investment, right? Well, with that $1,000, I could do a lot of things. I could take this particular investment opportunity that I've come across. I could do something like buy shares. I could just save the money in the bank and earn sort of a very low rate of interest just in a term deposit or something like that. I could go and spend it and buy goods with that $1,000 and spend it on consumer items, which wouldn't necessarily be a very good investment, but yeah, these are all things I could do with my money. So the opportunity cost of turning down this investment opportunity that I was offered is this 20% return. Because obviously if I do these other things, I'm not going to get that 20% return. I could get some other return or some other gratification or utility in the terms of buying goods, but I'm not going to get this same 20% return from this investment opportunity. So by me turning it down, yeah, that's my opportunity cost, and which is also the interest earned on that investment. So I guess the key takeaway is that interest rates, rates of return, discount rates, opportunity costs, they all essentially mean a very similar thing, which is the interest earned off money, and that's essentially just the difference in value of money across a timeline, with money today not being equal to the value of money tomorrow. Thanks for watching. Please like, comment, and subscribe.